I'm going to take you through my 12 essential rules for investing. These rules are designed to keep you on track, help you avoid costly mistakes, and make investing feel simple. These rules have been tried, tested, and proven by experts over decades. And by the end of this video, you'll have the confidence to make smarter investment choices for the rest of your life. Trust me, this is knowledge that can change your financial future, and I wish I had when I was just starting out. Rule number 12. Stay curious and keep learning. We're starting this countdown with what might be the most important rule for your investing journey. Investing isn't a one-time thing. It's a lifelong process of education. Markets evolve, new financial instruments pop up, and trends shift. The investor who stays curious and keeps learning will always have an edge. Think about it. There was a time where no one knew what cryptocurrency was, and now it's an entirely new asset class. Imagine not keeping up with that trend. You might decide not to invest in it, but you at least need to know what it is and how it's going to affect you and your investments. Dedicate 20-30 minutes of your time each week to learn something new about investing, whether it's reading a financial article, watching a documentary, or following a trusted YouTube channel like this one. That time will compound into valuable knowledge. So think of learning as an investment in yourself, and that's the most powerful investments of all. Rule number 11. Avoid chasing past performance. This one is crucial because it's a trap that's so easy to fall into. When I was just starting out, I can't tell you how many times it happened to me. Let's say you see a stock that just had a crazy run, up 200 or 300% or maybe more. It's natural to think, wow, if I jump in now, I can ride the wave and make a killing. But that's what we call chasing past performance. And it's a dangerous mindset. Just because something performed well in the past doesn't mean it will continue to. Stocks, sectors, even an entire market can be unpredictable. The companies that were hot last year might underperform or even crash this year. And when you're chasing, you're usually buying at inflated prices, meaning your risk of losing money is higher. Instead of chasing, focus on what's called mean reversion, which is the tendency for prices to eventually return to their long-term average. This means that if a stock has had a massive run, it's often better to wait for a pullback or even look for underperforming stocks that are due for a comeback. Remember, it's better to invest in a solid company that's temporarily undervalued than one that's overhyped and overbought. Rule number 10. Invest only in what you understand. Here's a rule that sounds simple but is often ignored. Let me paint a picture. You hear about a hot new technology company that's set to revolutionize an industry. The stock is skyrocketing and everyone is talking about it. And you feel like you need to get in on this action. But do you actually know what the company does? Do you understand their business model, their risks, their revenue streams? And you feel like you need to get in on this action. Investing in something you don't understand, it's like driving a car blindfolded. You're looking for trouble. If you don't know what makes a company tick, how will you know if something goes wrong? How will you know when to sell or if you should buy more? This is especially true for complex investments like options or certain tech sectors. A great way to ensure you understand your investments is to follow this rule. If you can't explain why you're investing in something in 1 or 2 sentences to a friend or a family member, you probably don't understand it well enough. Stick to investments you understand and you can wrap your head around. It will save you from a lot of stress and potentially a lot of losses. Rule number 9 is about keeping your investments in check. Imagine you started off with a portfolio that's 60% stocks and 40% bonds. Over time, the stock market booms. And now you have a portfolio that's 80% stocks and only 20% bonds. While that might sound great on paper, it also means you're taking on a lot more risk than you originally planned. Rebalancing is like doing maintenance to your car. It keeps everything running smoothly by ensuring your portfolio stays in line with your risk tolerance and long-term goals. You're essentially selling some of what's gone up and buying what's gone down, which also helps you buy low and sell high automatically. Now, you don't have to rebalance constantly. Once or twice a year it's usually enough, and some investment accounts like 401ks even offer automatic rebalancing, which makes the whole process hands-free. Whether you're doing manually or automatically, rebalancing is one of those small tweaks that can make a big difference over time. Rule number 8. Focus on fundamentals, not speculation. Let's talk about rule number 8. Now, it's tempting to jump into speculative investments, whether it's a meme stock or the latest crypto trend. But here is the truth. Speculation is basically gambling. And unless you're a professional trader, you don't want to gamble with your hard-earned money. What should you focus instead? Fundamentals. This means looking at things like company earnings, revenue growth, profit margins, and debt levels. These are the real indicators of whether a company is strong and likely to grow in value over time. One of the best tools for evaluating a company's fundamentals is something called the price-to-earning ratio. It tells you how much investors are willing to pay for each dollar of a company's earnings. A high PE might mean that a stock is overvalued, while a low PE might be a sign of a bargain. Stick to companies that have strong fundamentals. You won't get the thrill of quick wins, but you'll sleep better knowing you're building wealth on a solid foundation. Rule number 7. Don't let emotions drive your decisions. This one is easier said than done, but it's critical. When the market drops and your portfolio is bleeding red, panic can set in. Fear, anxiety, and even greed can lead us to make a rash decision. Maybe you sell out of fear of losing more, or buy into a stock that's skyrocketing because of fear of missing out. Here's the thing, emotions are the enemy of investing. If you let emotions drive your decisions, you're more likely to sell low and buy high. The exact opposite of what you should be doing. One way to combat emotional investing is to have a clear written plan. This is often called an investment policy statement, or IPS. It outlines your goals, risk tolerance, and strategies for dealing with market volatility. So when emotions run high, you can refer to your plan and stick to it. Remember, the market goes up and down, but history shows that it trends upwards over the long run. Don't let short-term emotions derail your long-term success. And now for rule number 6, keep your investment low. This might seem boring compared to picking the next big stock, but believe me, it's a game changer. Every dollar you pay in fees is a dollar that's not working for you. Let's break it down. If you're paying a 1% management fee, that might not sound like much, but over 30 years, it can reduce your total portfolio by hundreds of thousands of dollars, depending on how much you're investing. Look for low-cost options like index funds or ETFs. Lowering your fees is one of the few things you have complete control in investing, so take advantage of it. Alright, here's rule number 5. Reinvest your dividends. This is one of those sneaky little secrets that can supercharge your portfolio over time. When you own dividend-paying stocks, you have two options. You can either take the money and spend it, or you can reinvest those dividends to buy more shares. And let me tell you, reinvesting is where the real magic happens. Let's say you invest in a stock that pays a 3% dividend. By reinvesting those dividends back into the stock, you're effectively using that 3% to buy more shares. And guess what? Those new shares will also earn dividends. This is called compound growth, and it's the key to building wealth over time. Many brokerage accounts offer something called a dividend reinvestment plan, which automatically reinvests your dividends without you having to lift a finger. Look into setting that up for any dividend-paying stocks or funds you own. So don't just take those dividends and spend them. Reinvest them and let your money work for you. Rule number 4. Avoid trying to time the market. This is one of the hardest lessons for new investors to learn, but it's absolutely essential. Market timing is the idea that you can predict when the market will go up or down and make moves accordingly. Sounds great, right? Buy low, sell high. But the reality is, even the pros can't consistently time the market. Here's the thing. If you're constantly jumping in and out of the market, you risk missing the biggest up days. Studies have shown that if you miss just a handful of the best performing days in the market, your overall return can drop dramatically. Instead of trying to time the market, focus on what's called dollar cost averaging. This is where you invest a set amount of money at regular intervals, no matter what the market is doing. Over time, you'll buy more shares when prices are low, and fewer when prices are high, which smooths out your investment over the long run. Remember, it's about staying a long time in the market, and not timing the market. Be patient, and let the long-term growth of your investments do the heavy lifting. Now we're getting into the top 3 rules, and rule number 3 is understand your risk tolerance. Investing always comes with risk, but not all risk is created equal. Your risk tolerance is how much risk you're comfortable taking on. And guess what? It's different for everyone. Some people can handle the roller coaster ride of volatile stocks, while others might lose sleep over every single market dip. It's crucial to know where you stand on this spectrum before you start investing. If you're young, you might be able to tolerate more risk because you have more time to recover from market downturns. But if you're nearing retirement, you'll want to be more conscious and focus on preserving your capital. Here is a quick way to understand how you feel about your risk tolerance. Think about how you would feel if your portfolio dropped 20% overnight. Would you panic and sell, or would you see it as an opportunity to buy more at a discount? Your answer will give you a pretty good idea of your risk comfort zone. Understanding your risk tolerance isn't just about protecting your portfolio. It's about protecting your peace of mind. Make sure your investments align with how much risk you can actually handle. Rule number 2. Invest for the long term. Rule number 2 is something that every successful investor lives by. The stock market, by nature, is volatile in the short term. There will always be corrections, crashes, and periods of uncertainty. But when you zoom out and look at the big picture, the market has historically trended upwards over the long run. This is why long-term investing works. Instead of trying to make a quick buck by timing the market or chasing hot trends, you're betting on the sustained growth of the economy. Patience is key. If you're investing for the long term, consider focusing on index funds or broad market ETFs. These funds spread your investments across hundreds or even thousands of companies, giving you instant diversification and exposure to the overall market's growth. Think of it this way. If you're investing for retirement or a major life goal that's 10, 20 or even 30 years down the road, the short-term fluctuation shouldn't concern you. Stick to the plan and let compound growth work its magic. And the final and most important, rule number 1. Diversify your portfolio. Diversification is often called the only free lunch in investing. By spreading investments across different assets, industries, and even countries, you can lower your risk without sacrificing potential returns. When you put all your money into one stock or one asset, you're taking on a lot of risk. If that one stock crashes, your entire portfolio takes a hit. But if you diversify across tech, stock, healthcare, and bonds, the losses in one area can offset the gains in another. A simple way to diversify is to follow the core and satellite approach. Your core investments are broad, diversified funds like the S&P 500 or ETFs. Then, your satellite investments can be smaller, more targeted bets on sectors or individual stocks that you believe in. Diversification doesn't guarantee you'll never lose money, but it does give you a better chance of smoothing out the bumps along the way and staying in the game for the long time. If you follow these principles, you'll be well on your way to becoming a smarter, more confident investor. Check out my other video on how I keep my finances stress-free with one simple rule. If you found this video helpful, don't forget to hit the like button and subscribe for more content just like this one. Remember, investing is a marathon, not a sprint. Thanks for watching, and I'll see you in the next one.